Joining me now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, good to see you. Thank you so much for being here. What you make of the Fed meeting yesterday? Futures market pricing in an 85% chance of no cut in July. What are you expecting?
I'm expecting maybe no cuts for the whole year, and I know that sounds crazy, but when we start talking about, I read a great op-ed a few weeks ago, the Fed should take the summer off. Right now, I think the market expectation is Powell's clear. He doesn't know what tariffs are going to do, so he doesn't know the size or magnitude of the hard data. And absent that, I think the market narrative is slowly becoming we're not going to see any significant cuts or any cuts until May 2026, where the market narrative is Scott Bessent is going to be the new new Fed chairman and will be very dovish and cut rates. I'm not saying that's really going to happen in that order, but that is the narrative that traders are thinking. At least by May, we get the cuts. Between now and then, if we keep pausing tariffs every 90 days, we may not see that spike of inflation until late next year or even early next year, late this year.
All right. Gregory, jump in here. What do you think?
Good morning, Lee. So I guess my question would be, I don't necessarily agree with your rate scenario in general, which is fine. I think rates will be coming down before May of 2026. I guess my question would be, if rates, based on where we're priced right now, if rates don't come down before May of 2026, what do you think that means for equity markets?
Well, I think you're going to have a real hard time getting much past the all-time highs now. We've got equity growth right now, but a lot of that depends on where the tariffs are. I don't think the American consumer necessarily needs lower rates to keep spending right now. The housing markets are what they are. But if we don't get those rate cuts, I think you have to think, can the market manage those expectations through the end of the year? If we get tariffs, and we start seeing actual bumps in inflation start hitting this fall. Remember, I was here in January saying we're going to be summer inflation, but we didn't get the tariffs done. So I think it all has to do with managing the expectations when the tariffs start, when the consumers actually feel it, and at that point, the Fed's going to have to act. I'm kind of with you. I think if the Fed doesn't act by May, we could see some kind of recessionary pullback. I think we could see easily 5-10% coming down later this year, even in the absence of actual inflation, just the perception the Fed won't act until May. And I think that's slowly starting to sink in.
Well, Iran launching a fresh wave of attacks on Israel overnight, striking the largest hospital in southern Israel. Israel, of course, has been targeting the nuclear infrastructure, sites inside of Iran, including the nuclear complex. Iran is focused on citizens. How is this weighing into your thinking here? I mean, President Trump spent a second day in the Situation Room. He said he has a plan for every scenario, watching to see if Iran steps back from the nuclear program. Lee, is this affecting how you're looking at markets?
Not longer term. I believe Iran without nuclear capabilities make a safer world, gives more certainty to markets, and that's a net positive for bond and stock markets. I think right now, from a market perspective, we're seeing a lot of speculation in oil. I think people are just simply bored ahead of Q2 earnings. You'll see tickers like the big ETF to trade oil is USO right now. I just read a report yesterday that hedge funds have the highest allocation to energy in 5 years.
Wow.
That is simply a trade. That is a trade. I think it could last all summer. But we have to really look at demand destruction and what OPEC's going to do before you look at energy as a longer-term issue. I still like industrials and aerospace. And I still think that is more of the value trade along with financials right now. And I think outside of that, eventually we're going to have to go back to the main theme, which is AI, artificial intelligence, and the mega caps. I have a sort of a tough relationship. It's my frenemy. I love to make money on AI. The valuations are always hard to swallow.
Yeah, interesting. Michael, jump in.
Hey, Lee, how long until the consumer sentiment begins to wane as a result of the Middle East conflict? If we start to see a spike in oil prices, we start to see pain at the pump, at what point in time does the consumer sit there and say, I'm going to pull back and I'm not going to continue spending?
That's all I was thinking about the last week. So right now, oil's at this high. Oil's actually not much different than where it was in January. So we're only at the top end of what oil prices have been, say, maybe in 2024. So I think it's going to take some time for consumers to really feel that pain. Now, we can always see a shock, but when you really look at it from last year, how high are oil prices? We're up big because oil has slumped from the perception of demand destruction from the Liberation Day situation, put it that way. So I don't really see oil today as a problem. But if we start seeing getting up close to 90, I will have a different tune to sing by 85, 90 a barrel. Yeah. 75 to 80, less concerned.
Yeah, I was surprised that we didn't see a bigger spike, actually. Lee, good to see you. Thanks so much.
Thank you.
All right, Lee Munson. We're